Good evening, students. Last week, we lectured or we listened to the lecture on entrepreneurship. Now we are continuing the same discussion. Now for an entrepreneur to make a choice or the form of businesses he should associate himself with, he has to understand certain characteristics or certain information as to the choice of businesses, because this may border on issues of how to raise finance for the business, or how to the legal requirement for establishing businesses. So we will continue today's lecture, and in today's lecture we will be looking at establishing businesses. Now, at the end of this lecture, these are the following learning outcomes that we expect students should be able to familiarize themselves with. Understand and discuss the key considerations that are applicable when a form of business has to be chosen. Students should be able to distinguish between the different forms of enterprises that are found in South Africa. Explain the objectives, importance, and the need for a business plan. Evaluate a business plan. Give an overview of a business plan, and identify the location factors and the impact on businesses. This section is outlined in these various forms. We will listen to the introduction, the legal forms of ownership, developing a business plan for the new businesses, the location of the businesses, and we'll give a summary, then we conclude for today's lecture. Now, this chapter focuses on the different forms of entrepreneurs that are available, different forms of enterprise that are available to the entrepreneur. It really explains the factors that should be taken into consideration in selecting an appropriate form of enterprise for a particular business. The characteristics of sole proprietorship, the partnership, the closed corporations, the company, the business trust, and the cooperative society are well explained in this chapter. So basically, this section, we are going to take these various forms of businesses and we are going to analyze their characteristics, their advantages and disadvantages. This is because the entrepreneur is faced with the choice of how his business should be run. Then once an entrepreneur is being faced with these choices, he must be able to understand the features, the advantages and the disadvantages that will inform his choice and the form of business that he should do. Also, we are going to discuss the business plan, how to develop a business plan, and the features that goes into it that will also inform our discussion today. Now, we begin our discussion with the legal form of ownership. So as I have discussed earlier, an entrepreneur can conduct businesses through different forms of enterprise. Here, an enterprise here is an organizational structure through which businesses is conducted. Several options are available to the entrepreneur. The entrepreneur must know that the decision that he makes to inform, or the decision he makes which informs the choice of ownership, is basically going to affect the issues of finance or issues of legal risk, who controls the interest of businesses and how businesses should be financed. So this section is actually important, and entrepreneur must be able to understand all the available choices, the features which will inform his decision. So basically, we are going to understand or discuss certain characteristics of enterprise forms. And with this, we are going to make reference to issues of independence, issues of liability, issues of control, issues of compliance, issues of taxations, and issues of transferability. Now, once you're able to discuss these features is what is going to be, the entrepreneur is going to base his decisions on under the various forms of businesses. So the considerations in choosing a form of businesses the main kind of references or the main kind of considerations an entrepreneur should be able to look out for is what has been outlined here. We are going to take this ones one by one, and we are going to discuss them. Sorry, we are going to take this one by one, and we are going to discuss them. Now, the first form of consideration an entrepreneur should consider in the form of enterprise or in the form of business entity is to consider the legal personality. Now, a legal or jurisdictional person exists independently of its members. A legal or the jurisdictional person exists independently of its members. It is recognized as a legal subject alongside natural persons or individual. So this legal entity is recognized alongside natural persons or individual. It has its own rights, assets, and obligation. Its existence is not affected by changes in the membership. One important feature about this legal personality is the perpetual existence, or it ensures businesses continues so that there will be continuity in businesses. Therefore, businesses could potentially exist forever. With this feature of ensuring perpetual existence, it ensures that businesses could survive forever. So the legal personality, this one is, a different form. There should be a legal backing, which is different from the natural members in the business entity. It should be independent of the members, and this should help the business survive so that they should tell who would take over the business. It spells out who liability, who is liable, who is, how the business format or how business should take place. So members enjoy limited liability if members under this jurisdiction. So the members in there are what we call the natural persons. So members enjoy limited liability, and they usually stand to lose only the capital they have contributed to the entity. So this legal personality is independent of the businesses. It actually spells out the information as to how and businesses should be run and who will succeed the business, or how members under this legal personality. The members here are what we call the natural persons or the physical persons. So these members enjoy what we call limited liability. So one basic feature about the legal personality is about the perpetual existence. It's about the perpetual existence. Sorry for the background noise. Okay, let's continue. I believe you'll hear me loud and clear. Another important feature that a business enterprise or an entrepreneur should consider when forming an enterprise is what we call the limited liability. Here, limited liability is basically the protection afforded to the jurisdictional person, to its members or owners in the event of it being sued. So when claims are actually made against a company, the limited liability actually tells us how the company can make payments to the debts or claims against the company. So basically, it helps us to separate personal estate from the company's estates. So it helps us to distinguish what we call the personal estates from the company's estates. So when there is any form of liability, it helps us to spell, or it directs the creditors as to which form of assets that they can base their argument on, or they can actually have control. So the claims, for example, here we can say that once somebody makes a claim against a company, the assets for payment of the company's debt, and as you make the assets, you make the claims against the company's debts and assets for payment of the company's debts. The claim should not be against the personal estate of the company shareholders. So limited liability actually tells us that whenever there is a liability or whenever there is a claim against the company, which form of asset can be used to defray or can be used to settle those claims. And in basically it spells out that it should be the claim on the company's assets and not the personal estate. However, we should know that sometimes in certain circumstances, the liability of the company can extend to the personal estate when their decisions or their decisions as to the involvement of these individuals basically what contributed to the debt. Then there are certain legal settings that can extend to the personal estate of these individuals. Therefore, the extent of the liability of business owner is very important consideration when you are forming a business, because every entrepreneur would want to distinguish his personal asset from that of company assets, so that whenever there is a form of liability or whenever there is a claim against the company, the entrepreneur will not lose everything that he owes. So the degree as to the extent as to how liability and the extent of a liability of a company is very important, so that it will inform entrepreneur. If you engage in sole proprietorship and there's a form of liability, how the entrepreneur is going to be affected. If you engage in company, if you engage in any form of business enterprise, how does liability, or whenever there's a liability, how do the entrepreneur suffers? So we should be able to understand that it is an important aspect in forming a business. We will continue with the degree of control over, or the degree of control or the management authority. Here, a broad range of options exist in this regard. So, for example, when we talk about the sole proprietorship, for example, that is an individual owner of a business. Basically, he owns or control over the whole businesses. He owns and control over the whole business. So the total degree and management of the business is actually in the hands of one individual. Now, when you talk of the participative management or the structures such as partnership, cooperative, and closed authority fall in between these two. That is participative management. The ownership here basically is in the form of a managerial role. We can also talk about a business trust. So here in a trust, the deed can option control between the trustee, the establisher of the business, and the trustee beneficiaries. So the different types of ownerships that we are going to discuss later on, we should also know that they have different degree of control or different degree of management. In sole proprietorship, we said that the control is in the hands of an individual. In terms of the others, such as the partnership, the cooperative, the closed corporations, basically those ones are in the hands of management. So we should be able to also distinguish this form of enterprise. Also, another feature is, or another consideration is a potential for capital acquisition. The potential for capital acquisition. We should understand that some businesses are extremely capital intensive, and this factor may be decisive. So this factor may be, a decisive, it may be a very important decisive factor when considering the form of businesses. Some businesses are extremely capital intensive, whilst others are less capital intensive. So for example, a public company is ideally suited to raise large sums of capital. In a public company, for example, is assumed to raise large sum of capital. Others such as partnership, closed corporations, and cooperative society, the capital is provided by a limited number of persons, And for example, for sole proprietorship too, the capital is maybe from the person's own financial choice, or may have to being supported by a family or a close relative who may be wealthy. So the capital acquisition is actually an important play in terms of choosing a form of businesses. We will continue with also another form of consideration, which is the compliance with legal formalities and regulation. The compliance with legal formalities and regulations. This can impose a considerable administrative and financial burden on an enterprise. Yes, it can impose a considerable administrative and financial burden on an enterprise. The requirements and the cost of the establishment, the management, and the dissolution of an enterprise form of enterprise differ, each form of enterprises differ. So how the enterprise, what requires in establishing an enterprise, the cost involved, the establishment, the management, the dissolution of the different forms of enterprise we are going to discuss later on actually differ. So irrespective of the enterprise form adopted, a business can be subject to multitude of other legal and regulatory requirements that often depends on the size related factors such as the turnover and the number of employees. So here, in terms of the compliance, if you want to register or if you want to go to the legal process of registering a business, you should be able to understand the various forms of requirements, regulations that are associated. And these are basically informed by the turnovers or the sizes, as we discussed last week, between 5 to 10, whether you want to be a small scale enterprise or a medium, large, all depends, all this kind of previous number of and regulations that are features associated are going to informed by legal formalities and regulations, and an entrepreneur must be able to comply with this in terms of his decision, whether he wants to be an individual, he wants to be a partner, he wants to be in form of a partnership or the various forms of businesses. Now, another important consideration that can also be considered is the issue of taxation. What we should know is that businesses must pay tax, and the tax can be in the form of an income tax, capital gain tax, transfer duty, vary depending on the kind of taxpayer. So the amount to be paid depends on whether the business is the owner operated, or whether the business is registered entity that has its own separate jurisdictional personality. So a value-added tax, which is levied at a standard rate of, let's say, 15%, is applied irrespective of the enterprise form. So there are various forms of tax regime that the enterprise must be able to follow or must be able to settle. So every company or every individual or every form of businesses is entitled to pay tax. And there are various forms of taxes. The taxes could be an income tax, which is on the individual's income, or it could be in the form of a value-added tax, which is same for irrespective of the various forms of businesses. And it could also be in the form of what we call company or corporate taxes. All these kind of taxes, the entrepreneur should be able to have knowledge of them, because if you decide to go to be a sole proprietor, there are some taxes you pay. If you decide to be partnership, there's other tax regulations. There are other tax regulations in terms of other corporate organizations. So entrepreneur should be able to inform his decision on all this. Okay. Now, in our discussion so far, the last form of consideration in terms of choosing an enterprise is what we call transferability. Now, here, it is very important because it is also one of the most appropriate enterprise form that an entrepreneur must inform him or herself, because the different form of businesses will explain to or will help the entrepreneur to know how that they can transfer certain form of shares, whether they can transfer shares to the public or not. So transferability is very important. When you take companies like a public company, it is easy to transfer shares because they're basically listed on stock exchange and they can sell some of its shares to the public. Now, with other companies such as the private companies, cross corporations, cooperative societies, transfer is basically dependent on approval of the other participants or other members in the organization. So it is very important. An entrepreneur must know his transferable rights or transferable issues that are associated with the various forms of businesses. So we begin with the various forms of businesses. So we start with the most simple one, that is the sole proprietorship. Now, a sole proprietorship is a business that is owned and managed by one individual. A sole proprietorship is a business that is owned and managed by one individual. A sole proprietorship is not a separate legal person. It's not a separate legal person. It does not exist independently of the owner or proprietor. So the lifespan of the business is linked to the lifespan of the owner. The lifespan of the business is basically linked to the lifespan of the owner. If the business is discontinued, even temporarily following the death of or the incapacity of the sole proprietorship, it may be difficult for the heir or transferee to resume the businesses. There is no legal separation of the personal. There's no legal separation of the personal and the business assets of the owner. So there's no differences in the personal assets and the business assets. The owner also does not enjoy any limitation on assets, does not enjoy any limitation on his assets. So whenever there is a risk, he can lose all his assets, the company business assets, as well as his personal possessions. Another feature too about this sole proprietorship is that the owner has direct control and authority over all the activities of the businesses. Compared to the others, this one is an individual who has all the rights. So as we discussed earlier, he has all the managerial role and ability to control. In terms of capital acquisition, the sole proprietorship depends on the owner's financial strength and credibility. So it is own financial strength or credibility, or the owner may also be sufficient assets or rely on debt servicing, or can also rely on loan as a source of capital. It can rely on a sufficient assets or rely on debt servicing or loans as a source of capital. Now, to also talk more about the sole proprietorship, to talk about more of the sole proprietorship, it may encounter difficulty. Sorry for the noise. A sole proprietorship may encounter difficulty in obtaining sufficient funds. Sole proprietorship may encounter difficulty in obtaining sufficient funds. So from a legal perspective, transfer of ownership of a sole proprietorship is reasonably simple. Transfer of ownership from a legal perspective, when talk of if he wants to transfer the ownership to a different person, because it's an individual owner, he can easily close down his job or transfer or sell the company to a different person. Now, what are the advantages and the disadvantages of the sole proprietorship, which are basically outlined here? It is simple to create. It is the least expensive way of beginning a business. So for those sole proprietorship we see in starting small businesses, it is basically the least expensive because the cost involved may not be high. The owner has the total decision-making authority, which we have talked about. There is no special legal restrictions. So it is easy to, engage in sole proprietorship. It is easy to start something small. You can start by either selling something or manufacturing something. It is just, there's no legal restrictions that is associated with that. It is also easy to discontinue when you realize that the business is not as you expected or the business is not making the profit you anticipated. You can easily discontinue. However, we should know that once there are certain benefits, certain things that can be beneficial can also be a negative. So the owner is personally liable without limitation. We have discussed this earlier, that whenever there is a risk, the person loses all the business assets as well as his personal asset because he does not enjoy limited liability. So another disadvantage we can also discuss is that there's limited diversity in skills and capacity is available. Limited diversity in skill and capability is available. Here, because it's an individual, he does not enjoy the contribution of other diversified skills from other members. He is the sole owner, the sole contributor, the sole decision maker. With other form of businesses, which is basically more than one person, every individual may contribute certain different skills to the business, which this sole proprietorship may not enjoy. The owner has limited access to capital because it's the individual owner, unless the owner is filthy rich. Since it's the individual owner, the source of capital is basically from his own savings, getting loans, and it's basically difficult being an individual person trying to get some huge amount of loans to start a business. There's also lack of continuity. We have also discussed this, that whenever there is a death or the sole proprietorship become incapacitated or become sick or is unable to, continue the business, the continuity of the business basically is halted because there's no new person, or he alone has the skill or the knowledge in continuing this business. He alone has the knowledge and skill in continuing this business. The second form of enterprise is the partnership. The partnership is basically similar to the sole proprietorship, and the two businesses share several disadvantages. So a sole proprietor, in terms of partnership, is a contractual relation between two or more persons who operate a lawful business with the objective of making profit. So it's a contractual relation between two or more persons called partners who operate a lawful business with the objective of making profit. Now, if you look at the Company Act number 71, 2008, which no longer applies. It no longer applies. It basically states that the number, or that there's a limit on the number of partners, which was limited to 20, though today it no longer applies. Now, some essential features of partnership in terms of some essential features of partnership is that partnership must be carried on a joint basis. Each member has something to contribute to the partnership, and whenever there's profit, it should be shared per the agreement on from these partners. And also there's some form of continuation. If one member is out of this partnership, there's some form of continuation of partnership. And also whenever there's risk, basically it's supposed to be shared among all these partners. And one important feature among partnership is that they should all also try to act in good faith. That is, nobody should try to undercut in each and his fellow partner. So when we also talk about the jurisdiction or the legal personality, partnership do not enjoy that benefit associated with the juristic personality. Partnership do not have a separate estate from the partners, and their personal assets are exposed to the risk of businesses. The partners in their personal capacity, rather than the partnership, such as jointly enter into all transaction or contracts. So whenever there is a claim against the company, the partners do not just lose their asset, they can also be extended to affect their personal estates. So what are some of the advantages and disadvantages that we can talk about partnership? There's ease of formation. There's ease of formation. So basically, we could be among people who understand each other, who try to contribute capital to form businesses. Then there's diversification of skills and ability of partners. So each individual contributes or have certain skills that can contribute to the growth of this enterprise. Legal jurisdiction and natural persons may be partners. So this legal jurisdiction, we are saying that there is not different. It's not different. So the legal jurisdiction and the natural persons may be partners. They may be involved in the company. There is increased opportunity for accumulation of capital because they are, a group of people. Contribution from each individual leads to higher capital generation. And there is also a minimal legal formalities and regulation. In terms of partnership, the formalities is very minimal. It does not require a whole lot of processes compared to the others that we are going to discuss later on. Now, what are the disadvantages? The personal liability of partners for the partnership activity. There's personal liability of partners for partnership activity. That is that they don't enjoy limited liability. And whenever there is, a risk, or whenever there is a claim, this person's assets can be touched. They can be touched. The relative difficulty in disposing of an interest in the partnership. The relative difficulty in disposing of an interest in the partnership. The partnership will terminate if any event. The partnership will terminate in any event if there is a change in membership. So whenever we change a member, it can affect the whole partnership process, and it can lead to the end of the partnership. Also, another disadvantage is that there is potential for conflict between partners. So if maybe the interest of basically this arises when there is a profit sharing or risk sharing. When there is not any laid down agreement, others may undercut others, resulting into conflict, and this may not be good for the growth of partnership. There's also lack of continuity. Succession is only possible through an agreement. However, a new partnership will be formed in any event. However, a new partnership will be formed in any event. So just like sole proprietorship, this one too, there's lack of continuity. But however, for there to be continuity, then a succession plan should be also laid down so that whenever a member decides to quit, then the succession plan to a new to bring on board a new member should also be taken into consideration to ensure this continuity. However, when such is not made available, it can lead to the discontinuity of the partnership. So we continue. The third form of our business enterprise we are discussing is the closed corporation. So a closed corporation basically has the characteristics of both a partnership and a company. It has the advantage of being a legal person that exists separately from its members. A closed corporation may have one or more members, but not more than 10. May have one or more members, but not more than 10. So a jurisdictic person may not be a member. A jurisdictic persons may not be members of a closed corporation, even if, except in certain very limited circumstances. So it's a jurisdictic person may not be members of a closed corporation, except in certain very limited circumstances. So as a juristic person, a closed corporation has its own rights, assets and assets and liabilities. So as a juristic person, a closed corporation has its own rights, assets and corporation. It has legal personalities. It has illegal personalities, which ensures the continuity of the business. It ensures the perpetual existence of the business, which is not influenced by withdrawal or entry of members. It ensures perpetual existence of the business, which is not being influenced by withdrawal of entry of new members. The members of the closed corporations are generally not liable for debt and liability. The members are not liable for debt and liability. In this instance, we say that they enjoy limited liability. They enjoy limited liability. Members share the management and control over closed corporation. The members share the management and control in closed corporation. The members share the management and control over closed corporation. A closed corporation may not make any payment to members in their capacity as members. For example, profit distribution or repayment of contribution, unless the solvency and liquidity tests are satisfied. Unless the solvency and liquidity tests are satisfied. So a corporation meets the liquidity test before the payment is made. So before they make payment from profit, then they must meet the liquidity tests or solvency test of the company. We will quickly look at some of the advantages and disadvantages of a closed corporation. It has the advantages attached to separate legal personality. As we have discussed already, members enjoy the benefit of limited liability. So it has the personal asset is different from the company's assets. So members are protected whenever there is a risk or a claim against the company. There is increased capital acquisition potentially. Looking at the number of people involved, it is easy to increase the number of capital. Management is relatively simple. So management, as we said, are being by the members in the company. They enjoy continuity. So with the legal personality in place, they enjoy continuity or perpetual existence of the business. What are the disadvantages? As we said, it is basically limited to 10 persons, and this may not be a good thing for the company. It will not be a good thing for the enterprises, not the company. For these enterprises, juristic persons may not be members, so they have to separate these juristic and persons from the corporation entity. No new closed corporations may be registered, so it does not allow for new closed corporations to be registered. Certain closed corporations are subject to stricter accountability criteria under the Company Act number 71, 2008, the Company Amendment Act number 3, 2011, and the Companies Regulations 2011. Another form of enterprise is the company. So the company is developed to meet business people's need to obtain more capital than they could through a sole proprietorship or partnership. So companies as business firms bridge many of the deficiencies and undesirable features of partnership. It bridges the deficiencies and undesirable features of partnership. People eventually, from a legal perspective also, a company is able to separate, a company enjoy all the benefits attached to separate legal personality, usually combined with limited liability of the shareholders or members, as well as potentially unlimited capital generating capacity. A company enjoys all benefits attached to separate legal personality, usually combined with unlimited liability of the shareholders or members, as well as potentially unlimited capital generating capacity. So the company is characterized by separation of ownership and control. In terms of ownership and control, there's some separation between, there's a formal distinction made between members or shareholders of the company and its members. We can also look at certain laws or that helps to distinguish certain types of companies. So we can have profit companies, and we can also talk about the non-profit companies. We can have the profit companies and non-profit companies. We can also talk about public companies and private companies. We can also talk about private companies and private companies. So under company, before we continue our discussion with the different forms of under company, we will first of all maybe talk about advantage and disadvantage, which I've discussed them under the features. We'll just quickly go through them. We have the legal, juristic, and natural persons may be shareholders or members of the company. There are no restrictions on the number of shareholders who may invest in the company. These are all important. Shareholders or members have limited liability. But however, there are certain exceptions, except in persons liability companies, where directors are personally liable for all contractual debts. The ability exists to raise large amount of capital. There is a separation of ownership and control. There is also continuity, and there is transferable of shares. There's some form of transferability of shares. But you can also talk about the legal, the disadvantages. And here the disadvantages is that there's high degree of legal regulations. There's a whole lot of legal regulations a company must be able to go through in order to be called a company. Then we can also talk about there's also going to be high operational costs. There's going to be high. So as we said that in terms of companies, we can group them into profit companies and non-profit companies. Under profit companies, we can further divide them into 4 different classifications. These are the public companies, private companies, state-owned companies, and personal liability companies. State-owned companies and personal liability companies. One important feature between the public company is that it can sell its shares, or the public can buy shares in the company. And a public company is also, it lists the shares on the stock exchange, and it allows, it can sell the shares to the public, compared to the private company. Here in the private company, they are not able to sell shares to the public. So in a private company, they are not able to sell shares to the public, but a private company can sell shares to the public. A private company can therefore not list its shares on the stock exchange. However, the public company may raise capital by issuing shares to the public. The private company, one important feature about the private company is that it must end with the letter PTY Limited, while the public company only ends with the LTD. So these are certain features that we can discuss between the public and the private. We continue with the state-owned. With the state-owned here, basically the company ends with the expression SOC Limited. It ends with the expression SOC Limited, and it must be registered in terms of the Companies Act number 71, 2008. 71, 2008. So these companies are obliged to appoint company secretariats and audit committees. Under the state-owned agencies, they are basically obliged to appoint company secretaries and state-owned committee. They are also subject to stricter accountability provision contained in Companies Act number 71 and 71 or 2008. 71, Companies Act number 71 of 2008. 71 of 2008. 2008. The last form of profit companies, which is the personal liability company. Here, directors are personally liable for all contractual debts of the company. So the shareholders enjoy limited liability as they stand to lose only the consideration they paid in exchange of their shares, only in exchange of what they pay in exchange of their shares, only of what they exchange in exchange of their shares. But however, there are certain exceptional in the sense that shareholders may be held personally liable for debts of the company if the juristic personality of the company has been abused. So in a personal liability company, the shareholders enjoy limited liability, but however may be held responsible if their juristic personality of the company has been abused by the people involved. Then they can be held liable. They can be held liable for such. It can be held liable for such. So the non-profit companies, now basically these are companies which are incorporated for humanitarian or public purposes. They are incorporated for humanitarian or public purposes and not for profit. Not for profit. So you can talk about some specific activities such as the promotion of a specific sport, cultural activity or charity. Cultural activity or charity. So the non-profit companies do not issue any of their profits to their members, but use their profit to promote the specific purpose for which the company was formed. They use their profits to promote the specific objective for which the company was formed, and not to share profit for its members. Okay, basically I have talked about this issue, but let me just quickly give a summary to them and the difference between a public company and a private company again. Now, we talked about the differences in the number of members required and allowed. Now we can also talk about the difference in the director number requirement. So for a private company, we require at least one director, but for a public company, we require a minimum of 3 directors. We require a minimum of 3 directors. We also talk about the fact that there's some transferability of shares. So public companies can sell their shares to the public, but private companies are basically limited in that sense. And we also talk about the fact that the general public can subscribe to the shares, cannot subscribe to the shares of the private company, as I just alluded to. Now we also talk about the fact that the private company basically ends with Pty Limited or Ltd versus the Ltd for the public company. Private companies, for private company, not as strictly controlled as public company in terms of legal regulation. So for public companies, it has a whole lot of legal regulations. It has a whole lot of legal regulations that it must follow. It must subject to some legal scrutiny compared to private company, which is less strict in terms of legal regulations. Another form of business that will continue is the business trust. So a business trust is a trust that has the object of conducting a business in order to generate a profit. It's a trust that has the object of conducting a business in order to generate a profit. It's basically established out of ordinary trust. So a trust does not have legal personality. A trust does not have legal personality. It does not have legal personality. Also, the trustee owns the trust asset in an official representative capacity. The trustee owns the trust asset in an official representative capacity and is also liable for the debt of the trust in his or her own capacity as a trustee. The existence of trust does not depend on the identity of the trustee or its beneficiaries. It does not depend on the identity of the trustee or its beneficiaries. The management of a trust is in the hands of the trustee, who have to exercise their duties in accordance with the trust deed under the supervision of the master or of the High Court, of the master of the High Court. So the capital of the trust is also provided by the trust founder or founders, by the trust founder or founders. It is easy and cheap to establish a trust. So given these features, we can also quickly go through the advantages and the disadvantages of a business trust. Now, it is easy. There's easy formation. There is easy formation. You can also talk about the fact that the natural and the legal persons may be parties to the trust, whether as a founder, trustee, or beneficiary. Parties to the trust enjoy limited liability. They enjoy limited liability. Extreme flexibility. There is extreme flexibility. There's also absence of onerous legal regulation. There's also absence of onerous legal regulations. There is also some form of continuity. There is some form of continuity. We can also go to their disadvantages. There's limited access to capital. There is limited access to capital. There is potential for conflict between parties. There is some form of potential for conflict between parties. Okay, the last form of business enterprise we are looking at is the cooperative society. So a cooperative society is an autonomous association of persons who unite voluntarily to meet common economic, social, and cultural needs by means of a jointly owned and democratically controlled enterprise. A cooperative society is an autonomous association of persons who unite voluntarily to meet common economic, social, and cultural needs by means of jointly owned and democratically controlled enterprise. A cooperative society can also be primary, secondary, or tertiary cooperative. So in terms of a primary, there should be basically a minimum of 5 persons. A minimum of 5 natural persons need to register. In terms of a secondary cooperative, basically are formed by 2 or more primary cooperatives to provide sectorial services to its members and may include juristic persons. With tertiary cooperative, it basically consisting of 2 or more secondary cooperatives whose object is to advocate and engage organs of states, the private sector, the stakeholders on behalf of its members. So the name cooperative society must always indicate what the principal objective of the cooperative is. It must always indicate what the principal objective of the cooperative is. In terms of decision making, there should be the structure of cooperative is a general meeting. It's a general meeting of members. It's a general meeting of members. It's a general meeting of members. Anybody may become a member of the cooperative. Anybody may become a member of the cooperative. A cooperative also has the capacity to do anything that it is necessary to carry out its objective, subject to limitations imposed by its constitution. It has every right or every means to carry out its objective, but it should not be subject to the limitations imposed by the constitution in the Cooperative Act number 14 of 2005 and any other law. We can also continue the discussion of cooperatives because cooperatives are formed through registration at the Special Department for Cooperative Society. This is basically a subdivision of the Companies and Intellectual Property Commission. Intellectual Property Commission. Cooperative society are similar to private companies in many aspects. Basically, like a private company, a cooperative society is also recognized as a legal person once it is registered and a registration certificate is issued. So a cooperative society are similar to private companies. Just is that when they are registered, it is recognized as a legal or juristic person. It is recognized as a legal or juristic person. A cooperative society is also similar to partnership in the sense that members work together for a common purpose. Members work together for a common purpose, being it on common economic or social or cultural needs, being it common economic or social or cultural needs, social or cultural needs. So cooperative society are jointly owned by members. Cooperative society are jointly owned by members. Cooperative society try to achieve economic advantage for their members. They try to achieve economic advantages for their members. When we bring our discussion, for example, in terms of cooperative societies in South Africa, basically they are in the farming communities. They are found in the farming communities and organizations that are selling or supplying products and services. They are found in farming communities, and they are also in organizations such as selling or supplying of products and services. So in this first section, we have looked at certain considerations that an enterprise or an entrepreneur must consider when choosing the form of business enterprise. And we've also looked at various forms of business enterprises, the advantages and the disadvantages. We have looked at the sole proprietorship, the partnership, the company, the close corporation, the business trusts, and cooperative society. We've talked about their features, we've talked about the advantages and disadvantages. So we'll end this one and we'll continue with the second part.